Hi, everybody. Chris Engelbert with Engelbert Financial Advisors in Allentown, Pennsylvania. And guess what? It is August 2025. So we do the first of the month update. And since it's in August, we are in the dog days of summer. So obviously, we've had some real hot weather here in Pennsylvania. And it's basically the home stretch before Labor Day weekend, and kids head back to college, school, etc. So it's the dog days of summer. So what's happened in July? Here's our chart of the S&P 500, and you can see that we added to June's gains another 2.29%. And we turned around August 1st, gave back about 2%, and now we're trying to rally. So you can see the large sell-off that happened in April and May, obviously due to the tariff tantrum that went on, and the markets recovered from a 21% sell-off. And if you've watched some of our other videos, we've said this recovery was one of the fastest recoveries in stock market history from a 21% sell-off. So what do we do now? We reached all-time highs. We followed through in July. We think that August and September are going to be very challenging because you've got some very important dates coming up. So one of the most important dates is in the third week of August. You have a Fed meeting in Jackson Hole. Why do they have a Fed meeting in Jackson Hole? The story goes that they had a couple of Fed governors who didn't really want to meet in the summertime unless they went to someplace fun. They ended up going to Jackson Hole so they could do some trout fishing. And lo and behold, it's called the Jackson Hole meeting. Now, why is that meeting very important? It's because of what's going on with interest rates right now. So we had a July employment number, and the revisions for May and June were revised down substantially, showing that the economy, as far as the labor market goes, seems not being doing so well. So what happened with the 10-year Treasury? The 10-year Treasury has gone below the bottom of the trading range just a little bit, 4.25%. We thought the trading range was 4.5 to 4.25%. We are now at the lower end of the trading range because in the July Fed meeting, the Federal Reserve Board Chairman Powell said, I'm not lowering interest rates. Well, now they have something called Fed Funds Futures where you can get an idea of what they're going to do. Right now, the Fed Funds Futures is saying that after the poor July employment number, that there's about a 50% chance of at least a 0.5% lowering in short-term interest rates. So right now, short-term interest rates, bank CDs are 4.25% for 1 month, 3 month, etc. The 10-year Treasury is right around 4.25%. So we have a really what's called a flat yield curve. Now, one of the things that we think is going to happen in 2026 is we think the short end of the yield curve, i.e., bank CDs and money market funds, are going to go from paying 4% to paying somewhere around 2.5%. That's a much more normal yield curve from that standpoint. So the question is, should you increase the duration of your bond portfolio? We think you should. Maybe not all at once, but if you have a lot of money tied up in bank CDs, we are taking a look at premium tax-free bonds. We're taking a look at mortgage bonds. We think that that's where the value is going to be. Now, if we get a hot inflation number due to the tariffs, which is a very good possibility, you could see the 10-year Treasury float back up to around 4.4, maybe even 4.5%, but we think that would be a tremendous value in fixed income if the 10-year Treasury got back up that high, because again, a normal yield curve has short-term interest rates lower than long-term interest rates versus what we're seeing right now, where short-term interest rates are the same as long-term interest rates. So let's sum it up. S&P 500 added another 2.25% in July, made some all-time highs, driven by tech earnings. But when you see this video, we will have had some very important tech reports. There was one that came out today, and this is not a recommendation to buy or sell. AMD, Advanced Micro Devices, reported earnings. They were not good. The stock is getting hammered right now. We think investors have to be very careful in the tech area because the valuations on these tech stocks are back to being astronomical again. Don't forget, obviously, August 1st, the tariff sanctions, kicked in. There's been a lot of chatter, raising tariffs on India, whether the EU is going to come to the table, etc. That's why we expect a lot of volatility in August, September, because these countries are still trying to work out whether or not they're going to do some kind of trading with the U.S. that, avoids tariffs or has a lower tariff as well. The other big news, important news event is obviously what's going on with interest rates. July, the Fed did not do anything as far as interest rates, but the third week in August, we have the Jackson Hole, and that's usually significant where it sets tone for interest rates for not only the rest of 2025, but into 2026. That's why we expect some short-term volatility in August, September after the second quarter earnings season ends. So that's the first of the month update in August. Again, you can watch this video on my app by texting Chris E, C-H-R-I-S-E, to 36260. Download my app because we put this exact same slide deck on there, and we put our video content as well. Again, if you have any questions, give us a holler. We're more than happy to talk to you about your portfolio and what we're doing and the strategies going forward. That's the August 2025 update. Thanks for watching.